Hi, I'm Stu Kagan, and welcome to Born Scrappy, the podcast for scrap metal exporters and traders. Join me in conversation with some of the most experienced traders and operators that have helped shape this incredible industry. In today's episode, we welcome Atilla Widnell back onto the show to discuss the latest steel news out of China. Atilla is the CEO and founder of Navigate Commodities and is extremely knowledgeable when it comes to the global steel market and specifically China and Turkey. With China having just had their annual sessions to discuss their way forward over the next year, I thought it would be great to unpack what we heard and the impact it will have on the global steel markets. In today's episode, we talk about China's National People's Congress, Chinese capacity cuts, structural reforms, global steel market complexity, the situation in Turkey, and so much more. So let's jump in with Atilla. But first, intro. Hi, Atilla. Welcome back to Born Scrappy. How are you?
I'm very well, mate. How are you?
Yeah, I'm excellent. It feels like it was just the other day we were in California on table scraps, and it was obviously just aired the other week. And it was we were robbed, right?
Yeah, we were robbed on the starters and the main course. I think the dessert is really where it let us down. I don't know who was in charge of that.
Wow.
I've never had a crispy tiramisu before, but it's
Wow, Attila, so much for being on the same team here. We're meant to be having a go at the Alta
friendly fire
and the OGs. You straight away go internally, right? That hurts. So really, we were robbed because we were the only ones who didn't need extra time. We were the only ones who finished in the right amount of time. So if it was like a Master Chef competition, we won it. So Alta would have served a raw piece of meat, and Andrew Lincoln would have served dessert with no sugar in it. Right, it was a savory biscuit, whatever it was, that wouldn't have worked. So anyway, that's what this podcast
in the USA. I think are there any other ingredients apart from salt?
Salt and sugar. That's pretty much it. But this podcast today is all about how we were robbed on table scraps. No, I'm just kidding. So, in case anybody switched off right now. The reason why we brought Atilla back on is because just the other day, the two sessions were held in China, and every year they have a massive impact on the steel market. And it's really important in our industry to, I guess, stay ahead of what is going on in those sessions. Can you, and Attila, I know how much you're aware of it. I know how much you monitor this. And it plays a part of, obviously Navigate Commodities and what you do because you do a lot of forecasting. So can you just give us some background on what these two sessions are for those of people that don't know and how it has an impact on global markets?
Yeah, indeed. Thanks, Stu. All jokes aside, the NPC is or the National People's Congress, two sessions is an incredibly important framework for the year ahead in China. It gets all of the high-ranking top officials together in one place. It's usually only announced a few weeks in advance. And it brings together all of these top-ranking officials to basically set out the theme of what's going to happen in the economy for the year ahead. So in actuality, the Chinese are very, very good at telegraphing of what they're planning to do ahead of time and then follow through in terms of executing. So these two sessions, which were held in early March, set out the principles and the guidelines with which the government, the state government, the federal government will focus on in the year ahead, and that will then inform the provincial level, the municipal level authorities of what they have to target in terms of their KPIs and what they have to achieve in the coming year ahead, what areas of growth to focus on. So, the whole sort of financial markets and the industrial metals markets like iron ore, steel, copper were watching these two sessions to look for any crumb of evidence, wording, sort of hat tips, nods, winks, in terms of what the government is going to focus on, in terms of any sort of industrial, heavy industry sort of sector support, in terms of stimulus, infrastructure programs, civil engineering, and so on. So that's why it's such an important sort of meeting, and that's why the financial markets sort of focus on it so much.
Yeah, I mean, if you can kind of think about it as a business, it's kind of like the annual strategy session that they sit down and do over these two sessions. And because of the importance of China and the global impact that it has, of course, everybody sits up and listens to, as you say, everything that's being discussed. And it has an effect on pretty much everything, specifically our industry, right? It has a huge effect on our industry. Can you talk us through what they spoke about when it comes to steel demand for infrastructure, real estate, and manufacturing? Where are we seeing that for the upcoming year? How's that going to go?
Yeah, so there's a lot to unpack. So we'll take it point by point. So because it's such an important meeting in terms of setting out where the government intends to focus on growth and sort of whether stimulate or focus its investment. Now, the majority of China's steel demand is heavily focused on sort of construction, infrastructure, civil engineering, with a more modest focus on manufacturing, which covers, automotive, so on, appliances, yellow goods, which will be your sort of farm equipment and so on. Now, obviously, so the key sector that was of interest for the financial markets, when I say financial markets, I mean derivatives traders that are trading, iron ore, steel futures, copper futures, and so on. So the sector of extreme interest was to see if there were any sort of acknowledgements in terms of heavy investment and stimulating sort of the construction infrastructure sector. Now, unfortunately, the government's sort of tone, wording, rhetoric since the two sessions has been heavily focused on consumption, supporting consumption. Now, that may sound like a positive for steel demand. However, it's actually turned out to be a negative. So when the Chinese government says consumption, they're looking at consumer demand. So consumer demand is not of, infrastructure and civil engineering. Consumer demand is of appliances, vehicles, and so on. So it's the sector that is probably marginally less steel intensive than sort of the heavier infrastructure and civil engineering side. So what they've come out with since then are sort of policies aimed at sort of trade-ins, so trading in your vehicles, your old vehicles for new vehicles, appliances for new appliances, and so on, sort of trading in farm equipment, buses. Those are all fantastic, but we've seen a lot of that over the last couple of years, and that hasn't really moved the needle in terms of overall national steel consumptions. Provides a little bit of buoyancy, but not enough to sort of soak up all of the excess steel supply in the Chinese system, which obviously, we're seeing flow out of the country and hit other economies en masse, which is obviously having quite a detrimental impact to other nations, which is why, we're now starting to see tariffs coming up on Chinese steel from, the likes of not only just the US, but Vietnam, South Korea, Japan. I think India are about to announce as well. The Turks are lobbying their government too, but that's another conversation for another time. So, it kind of disappointed, in short, is what I'm trying to say, because there wasn't enough sort of teeth around anything sort of infrastructure and civil engineering focused. So, there has been a mild improvement in sort of the deep, dark, depressing double-digit contractions from last year in terms of property, real estate, floor space under construction and completion rates, but it's still single-digit negative growth year on year. So, concerning is that actually there's not enough there at the moment to suggest that China is going to revert to stimulating infrastructure and civil engineering projects this year.
Right, so not positive news on the growth side of things, I guess, not what we were hoping to hear
On the demand side,
out
yeah.
of China. Yeah, for sure. So on the trade and export policies, I mean, when we talk about tariffs, because obviously it's what everybody's talking about at the moment, what signals did they give to any sort of change of their steel trade policies, if any?
Yeah. So I guess it goes back to the previous question or the previous answer that we were talking about in terms of them highlighting some capacity reductions, given that there's a persistent oversupply built into the Chinese steel industry. The interesting thing to watch, from last week, that when you're looking at the iron ore futures or steel futures in real time, they're highly reactive to sort of statements, headlines, comments made in the press. So if we're looking back to late last Friday in sort of Singapore's evening trading session between 9 and 11 p.m., it was morning time in the US and President Trump was talking about this sort of flexibility in tariffs potentially on China if discussions go well. And it was quite fascinating to see in the sort of financial derivatives markets for iron ore and steel futures in China that they were just started roofing because the sort of retail, non-sophisticated investor element assumed that was a good thing for Chinese steel and Chinese steel exports, because if the tariffs are sort of eased, then China can keep on sort of flooding the market with their excess steel. However, that's not necessarily a positive. Actually, it's a massive negative because, that means that the Chinese steel industry will remain net imbalanced in terms of supply heavily exceeding sort of domestic demand. And what that will basically do to the market is that it will crush sort of local prices and it will crush local margins and put domestic steelmakers into heavily negative territory, which will force the government's hand anyway to basically sort of close capacity later rather than sooner. I don't believe that the US tariffs will necessarily have or easing of US tariffs will necessarily have a positive impact on the Chinese steel industry. Actually, if you look to sort of other markets like Vietnam, South Korea, Japan, and Taiwan, they are the major importers of Chinese steel. And so, the majority of those countries have already imposed tariffs on Chinese steel, which will limit the flow of exports coming into their country. And that is going to force the NDRC's hand, CISA's hand, sooner rather than later to enforce those mandated production cuts, those capacity cuts in China. So it's starting to feel like it's more of an inevitability. The big question is, when will it happen and how quickly will it happen? So if you look back to 2015, there was enforced capacity cuts within the sort of induction furnace sector of the steel industry. It took them sort of 12 to 18 months to enforce about 100 million tons worth of capacity reductions. So we're sort of waiting for the first embers of news to start flowing that China are going to start sending inspection teams round or supervisory teams round to sort of oversee those capacity reductions to make sure blast furnaces are actually blown down. But I think it's really the tariffs in Asia. I think India are about to impose tariffs on Chinese steel as well, so that will add more sort of incentive for Chinese authorities to cut capacity sooner rather than later, because with a struggling economy, especially on the property sector side, they don't want to have a steel industry that's hemorrhaging money as well. So that will probably force their hand.
And with their focus on their domestic economy, how could that change, its steel export strategy?
So, again, it goes back to probably the first question. Like, we were hoping, and a healthy China is good for the world. Let's be honest, because they will be consuming raw materials and finished products and so on. Unfortunately, there was, lacking in detail around sort of investments and growth around sort of heavy industry and infrastructure and civil engineering. So if they're sort of focusing on, advanced manufacturing like semiconductor chips and, advanced industries and, maybe just focusing on trade-ins and manufacturing for the time being, that doesn't really support domestic sort of steel consumption to the extent that it needs to balance that demand supply equation. So it didn't go anywhere enough, which is why, financial markets, derivatives on Chinese industrials are sort of, fallen off since the beginning of March. There were high expectations of something to come. The government had made sort of nods and hat tips and, statements in the right direction. And unfortunately, they haven't followed through. I don't know whether that's a function of that they're sort of still waiting to see how things play out with the US, or whether they feel they can get by with a growth in other sectors apart from heavy industry. So they've been wanting to move away from sort of consumption-led growth for a long time, move towards services-led growth. And, I guess, your steel industry is the first one probably to suffer from that. And so they're trying to consolidate and structurally reform it so it's not such a burden on the country. But yeah, it's been a massive disappointment. So I don't think there's going to be much balancing on the demand side. It's probably going to come from the supply side this year and next.
But with the latest policies, what about the demand for other key raw materials like iron ore and coking coal?
Yeah, so that one's relatively straightforward. So, I mean, obviously, if we're going to cut 50 million tons or more worth of capacity, that obviously, logically implies that they're going to be consuming less iron ore, less metallurgical coal. So dissecting one, iron ore, they import the majority of their consumption. So they import sort of, I think it's about 80% of their consumption, and the balance is produced locally. With coking coal, metallurgical coal, it's reversed. They produce the majority of their consumption locally, and they import the sort of balance from countries like Russia, a little bit from Australia, a little bit from the US, Canada, and so on. But generally speaking, obviously, if you've got fewer blast furnaces operating, then you're going to require significantly less iron ore, metallurgical coal to produce hot metal. Now, I mean, every time there's announcements around steel capacity cuts, you see sort of an equal and opposite increase in rebar futures and a drop in SGX and DCE iron ore futures. So the market is playing out fairly rationally at the moment. So it's the iron ore market is understanding that capacity reductions will reduce Chinese consumption in the sort of medium longer term. And so that's why you've got sort of iron ore futures testing that $100 a ton level. You've got investment banks talking about iron ore prices potentially falling to sort of around sort of $80 by the end of the year due to sort of capacity reductions in steel in China, but also increased supply from new projects in West Africa, like the Simandu project in Guinea. That level might be a bit far-fetched because there's been a lot of cost push inflation. So the marginal cost curve, the sort of what's the word? The higher marginal cost producers have sort of gone higher on the marginal cost curve. So I mean, like sort of the highest cost producers, their marginal cost per ton is probably about sort of $90, $95 a ton now. So there won't be significant downside to come for iron ore, but you could find some weakness through the course of the year as sort of supply comes back from Australia and Brazil after they conduct sort of mine maintenance programs, and it gets the Aussies get over the tropical cyclones that they've been suffering from in Q1, and generally you start to see more supply come to the market in the second half of the year. So if that sort of intersects capacity reduction cuts in China, then you will get sort of weakness in the second half of the year, no doubt about that. But I wouldn't see it sort of falling off a cliff anytime soon.
Okay, so let's get to the crux of this. How do you think China's the policies are going to influence global steel prices, and have we seen any sort of movement already?
Yeah, so it's at present we're sort of it's kind of the status quo. I think sort of China is more sort of influential in markets that are still importing significant volumes of Chinese material. To the contrary, so if we look at US, somewhere closer to home, obviously tariffs not only on Chinese steel or Chinese goods, but steel from all other countries, has obviously had a material impact on their domestic steel prices. So, I mean, like, for example, US HRC has gone up 50% in the past 3 months. That's a function of obviously, not really tariffs on Chinese steel, but or finished products or indirect steel imports either. So whether it's vehicles or yellow goods or appliances, but actually it's tariffs on Canadian steel, tariffs on Mexican steel, for example. That's created the sort of tariff inflationary induced heat, shall we say? Now, I mean, there's so many elements these days. It can get incredibly confusing because, I mean, like, if you look at places like Turkey, for example, they've been importing significant tons of Chinese billets, bars, and rods. Obviously the local steel producers are being hurt by that, and they want to they're lobbying the government to try and affect their own sort of tariff measures. When you've got scrap trading at sort of $380 a ton CFR Turkey for HMS 128020, but you can import a ton of billet from China or Malaysia at $480, $485 a ton, that's a bargain. So those mills or re-rollers that have reheating furnaces or re-rolling lines, can buy in that billet, re-roll it, and make some good margin on that, because your cost of conversion from scrap in an EAF into a bar is probably about $170 to $190 a ton. So that means that scrap is well out of the market, out of the money, compared to what they're able to buy sort of semi-finished products for. Now, the difficulty is those mills that don't have potentially re-rolling lines to accommodate billets. Secondly, if you're buying billets from Asia, China, Malaysia, there's probably a 3-month lead time before, striking that deal and arriving on shore for you to be able to re-roll it. The difficulty comes if there's any sort of capacity reforms or structural reforms in terms of steel production in China, and the prices start to roof, then some suppliers in China and Malaysia have a habit of cancelling those physical contracts and then re-offering it out at a higher price. So you end up getting, for want of a better word, screwed. So there comes like an inherent risk in doing that trade. So, but at the moment, there's quite considerable volatility in Turkey at the moment, given some recent political risk. So actually, with the lira depreciating heavily last week, actually Chinese steel or Malaysian steel that's relatively cheap actually presents an opportunity in the short term. So it keeps them alive while they're having to sort of fight a depreciating lira. They're having to reprice their own domestic material in terms of rebar. Because of that, then they've had to stop purchasing scrap because obviously it's now more expensive on a US dollar per ton basis. So actually it makes sense to probably buy a little bit more Asian origin billets, take the risk, re-roll it, and sort of live to fight another day. So there's so many different layers and complexities all over the world. It's almost like each country has its own sort of specific individual dynamics at the moment, and it's obviously become quite hectic to look at, because the global steel industry is no longer a sort of living, breathing organism. There are pockets of sort of case by case basis. So you have to be sort of following very closely to understand how that might affect specific countries or regions or specific corporations, specific commodity verticals. So it's been quite a tough quarter. I'm not going to lie. It reminds us of the COVID years. It's been that intense just to keep up with developments and understand how that's affecting our clients' operations, and the sort of the analysis and research that we provide them.
So I just want to double click a little bit more on the Turkey situation, because this is happening as we speak. Can you just give us a little bit more of an explanation of what's happening? What sort of real impact is this going to have? Because the Turkey HMS price is a hugely important price globally. So what are you seeing
there? So I'll probably have to tread fairly lightly, carefully. So, but from what we read in the press, same with everyone else, is that key sort of opposition political figure has been arrested in Turkey sort of over the weekend, who I think presented a legitimate challenge to the incumbent's rule. Whether it's right or wrong, that's not for us to say. But obviously, how financial markets have reacted has been to sort of heavily sell anything related to Turkey, whether it's currencies, equities, bonds, and so on. And so, last week, using the Turkish lira as an example, at one point it depreciated by about 12.5%, sort of above 40 liras per USD. Now, obviously, that sort of signals that investors, financial markets, have a risk-off attitude to Turkish assets, and that they don't trust the government and they don't trust the economy. So that's typically your first signal that there's something wrong there.
But what have we seen on the actual scrap prices since then? Have there been any sales?
No, there's been no sales, and the market's sort of just gone sideways. The Turkish, I think, from what we understood from a couple of clients last week, that rebar sales have been suspended for a couple of days while the mills repriced on a Turkish lira denominated basis, and therefore at the same time they suspended tenders or bids for bulk ferrous scrap cargoes into Turkey. So at the moment, everyone's sort of scratching their head, waiting and seeing. If we're looking at the LME futures curve, that's pricing in a drop of about $5 a ton. I think it's too soon to accept the market will come off. If we sort of revert it back to the US, obviously US is a large supplier of ferrous scrap to Turkey, and the Chicago HMS #1 price is trading at a premium to the export price, meaning that actually it makes more sense for suppliers to feed the mills domestically than it does to export at a lower price. So there's obviously that theoretical tightness in supply, and so if the Turks want to buy a US origin scrap cargo, they're going to have to pay a premium for it. So it sort of sets the pricing floor a lot higher. So the pushback from Turkish mills is going to be met sort of by some significant resistance. It's like, well, we don't have to sell you that cargo because we get a better price locally. Yeah. So it's not a pretty environment. I mean, and the problem is that with the depreciation of lira, it's going to sort of cause this shock effect where people are going to stop buying steel, maybe pause until the economic environment and political environment become clearer. People are going to stop making investments in construction projects until, again, there's some certainty, and that hurts downstream steel consumption in Turkey, which means that Turkish EAFs are not going to be operating as at a higher utilization rate, which means that they're going to be consuming less scrap, which theoretically you would assume would push down the price. But if the price is still elevated in the US, you're going to be met with resistance. So you're kind of in this sort of limbo land where sort of economics is not making complete sense. And so demand is weak, but prices are high. But I think that's been a factor of the markets for quite a while. We'll just have to wait to see how that unfolds. Unfortunately, there are still protests in Turkey, and we'll have to see how that unfolds and whether some degree of normality and calmer heads prevail. And then we'll be able to take it from there. But at the moment, I think the general consensus is that sort of sideways until sort of things calm down, because no one's doing anything at the moment. I think on the supply side, there's sufficient material in Europe, but the Europeans are doing a good job of sort of keeping their prices relatively stable because they're like, well, if you don't want to pay a premium for the US material, we're going to charge you a similar rate, but obviously on a geographical spread basis. So, these are commodity traders, right? They're very good at the job.
Yeah, exactly right. Here's the toughest question of the night. So, what do you see the prices doing in the next 3 months?
So, a wise man told me to just forecast what I see in front of him. So at the moment, I think we have to bring this again back to the US, because the US is sort of is setting the pricing floor if we're talking about ferrous scrap and steel. So if tariffs remain on, imports of steel, which includes Canada, Mexico, if there are no exemptions or quotas, we would expect sort of, ferrous scrap prices, let's say into Turkey, into India, and so on, to keep on rising. But attritionally, Indian demand is not good at the moment. Turkish demand is not good at the moment. So there's a lot of resistance there. But if the prices in the US remain high and keep on sort of ticking up, then it will obviously increase the pricing floor for the export markets. But obviously you'll have that sort of ceiling with how much you can push up. And obviously, the current sort of turmoil in the markets, that will be capped at how much it can push up. So it'll become sort of quite attritional in nature. So that's the base case scenario. But I think as we've all become accustomed to in the first 3 months of the year, we don't know if tariffs will remain in place or will be taken off. So there's on again, off again volatility. Sort of financial markets are deploring it at the moment because no one likes uncertainty. No one likes, markets like volatility. For some traders, financial traders can trade that, but no one likes uncertainty. And it obviously hurts sort of big investments into the sector. So it sort of feels like it's going to sort of just tick up very, very slowly if the current status quo sort of prevails. I think obviously if tariffs come off on Canada and Mexico in the US, then you'll see an almighty correction lower. So that will come. So, in these sort of circumstances, if certain traders have access to sort of futures and options, you'd be sort of start investigating in terms of some sort of option strategy to sort of protect yourself from, the prospective downside. But yeah, that's sort of what we see at the moment, but it is a highly volatile, ever evolving sort of scenario at the moment. It's probably the most challenging sort of market to forecast outside of COVID.
And you're probably the only person in the world that would have actually said something to that question. So the only person I know that would have tried to answer that. So that's why we had you here. And Attilla,
as long as you're right 51% of the time.
As usual, man. Super informative. That was awesome. Thanks for being on the show again.
My pleasure, Stu. Thanks for having us.
Cheers.